forward, you go from a poor country to a slightly wealthier country, and so on and so forth. You're always trying to upgrade.
Yeah,
New Zealand's up here.
Yeah,
right. We're up here.
Yeah. It's important for us to remember that from time to time,
I
right?
think so.
We're a highly desirable
We
place
forget
to
about
live.
it.
Yeah.
We forget about that.
Yeah. Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair, and today we've got an extra special guest, Jarrod Kerr, Chief Economist at KiwiBank, to talk us through the markets and what's happening in the economy.
Jarrod, welcome to the podcast.
Thank you. Thanks for having me.
So I got to tell you something, and my main job in life is to try and embarrass Mike.
I knew you were going to say that.
Yeah. So Mike is fangirling a little bit. So in a previous life, he was an economist. And so he's come to me multiple times after attending your presentations and tells me about how good they are. And then for the next month or so afterwards, rips everything off the back of it and steals every quote that you have.
It's one of those that you watch some people speak on these topics, which by and large can be quite dry for people who aren't interested in them. And you're like, oh, man, you're not doing the topic, or the economists any favors here. But I think most of the, like every time I've watched you present, I've been like, you do a really good job of just kind of putting it in terms that your average person can understand and that they can use to try and make decisions off or influence the decisions they're going to make in their life, which I found really useful.
Yeah, it's nice to hear. Thanks for that. It's, I think, when you're talking to a group of people and if you talk to them like an economist, they just go blank.
Yeah.
It's like CPI's done this, GDP's done that. And it's like, oh, wait a minute, I don't even know what they stand for. Speak plainly, it's inflation, it's growth, it's whatever. And people respond a lot more, I think, when you try and just cut all the jargon and the crap that economists talk about. I mean, I can't believe you're an economist as well.
No, I've never been an economist. I studied economics.
Studied economics.
I studied economics. You've really overshot that, man.
So today, Jarrod's in a lot of presentations and we've got a little bit of pack with a lot of information in it, where we're just going to talk about what you're seeing going forward, how you're feeling about New Zealand, because it's been a tough couple of years, isn't it?
Oh, absolutely. I mean, we've gone through extraordinary times.
Yeah.
For me, 2008 was my crisis, right? I thought, this is it. This is, as bad as it's ever going to get. And then, we've had a few things since then, but the pandemic, was incredible. I speak to the KiwiBank board probably twice a year in normal times. During the pandemic, I was talking to them every morning. That's how bad things got.
Wow.
And we had like the proper war room set up and, how many defaults are we going to face? What's the unemployment rate going to be? Asking all these questions. No one knew the answer, obviously, because we had no history. The only history we had when, people put their borders up is during war or, back in the 20s. So we didn't know. And central banks did everything they could. So they slashed interest rates. They pumped trillions of dollars into their economies.
Yeah.
And we came out of it much better than we thought. And now we've got this, massive inflation problem. So we've gone through some extraordinary times. And like you say, the last couple of years is kind of mopping up that excess demand and trying to get inflation back down again, which is proving to be a real challenge.
Yeah. And I know hindsight's 2020, but do you think that perhaps there was too much stimulus and rate cutting? And did you think that at the time? Or was that more just, again, the hindsight thing?
I think at the start of the pandemic and the initial reaction from both the governments and central banks, we were all on the same page going, we need to do something pretty drastic. And the wage subsidies really worked. Rate cuts obviously worked. But then towards the end, we did start asking questions. Maybe we are going too far.
Yeah.
Our central bank was flirting with the idea of a negative cash rate, and we pushed back against that quite hard. So yes, we definitely did too much. And the problem now is that we've got very high interest rates to try and mop all that up.
It's funny you bring up the negative cash rates thing, because I remember banks at the time going like, our system isn't built
Yeah.
for a negative. How the hell are we going to do that?
Yeah.
It was like a Y2K problem.
Yeah.
We've never had a negative interest rate. Well, actually, they became quite common. And $20 trillion of superannuation funds and people's money were invested in negative interest rate products. So, believe it or not, in a really bad environment, you put your money. Okay, I'm gonna pay -1. I'm gonna receive -1% on that.
Yeah,
I would prefer that than being in equities and potentially losing 20% or anywhere else. So money actually funneled into negative rates.
Yeah.
And that goes against the theory. The theory is a negative interest rate, people rip their money out and do something else. Actually, it turned out to be the safest option for many people.
I mean, you think about the mindset at the time, right? And you mentioned just all of the unknowns. You touched a little bit on, you talked about the GFC and then mentioned COVID, and you thought the GFC would be the biggest crisis that you go through.
Yeah.
When obviously very different crisis, but if you compare them in terms of the size and the impact, how would you measure what we've recently gone through versus the GFC?
Well, the GFC was much worse, but a lot slower.
Yeah.
It was really slow. Like, it started in 2007. Everyone says 2008 because that's when things really started blowing up. But it actually took quite a long time to unfold. And it lasted a lot longer. And then we had, 10 years of regulation pretty much after it to make sure it never happened again. The pandemic was, overnight we were locking up borders and, restricting the economies that way. So it was a lot faster and harder. And we bounced out of it, so much better than anyone thought. It was it was a really short, sharp event compared to 2008.
Yeah. So I guess and obviously we'll get into it in more detail as we go. How are you feeling about, maybe we'll start with New Zealand we're sitting in February 2024. How are you feeling about New Zealand at the moment?
Oh, look, better than I was a year ago. Thinking about the end of 2022, things were turning and you could feel it. And businesses were telling us couldn't find workers and all this problem. Now they are more worried about their future. They are a bit more worried about the outlook, and that's because it is quite mixed and challenging at the moment. But I'm a bit more optimistic. I'm optimistic because the housing market's gone through its downturn. House prices look like they're going to go up this year, that's massive for a Kiwi economy just in itself.
And a mortgage broker.
And a mortgage broker. Yeah, that's right. But also small businesses, right? Yeah. That's quite important for their confidence and so on. So I think, we're going to get better growth this year and next year. And I think the Reserve Bank will end up being in a position where they can start cutting rates back to more normal levels.
Yeah. Okay. Yeah. And what do you think in terms of how the year plays out, whether good or bad or meets expectations or doesn't, what do you think the key themes will be for the year that'll dictate the outcome?
Inflation.
Yeah.
It is. That's the big shock that we've had. Central banks globally are kind of desperately doing what they can do to get inflation back down towards 2%.
Yep.
I think they're winning that battle, which is important. Still a long way to go, but they're winning that war. And once they can sort of put their stake in the ground and say, we have won the war, inflation's back below 3, then I think equity markets and asset markets will become a lot more confident given interest rates have peaked and will start falling.
Yeah.
And that's key.
Yeah.
It's absolutely key. Inflation, tick, interest rates, lower, higher growth, higher output into next year.
Yeah, and I guess one of the things that we're always hearing from the government is a lot of talk around immigration into the country and the effects that has on the economy as a whole. How do you think that's going to play out this year for the country, and does that have an impact on those inflation numbers as well?
It does. Short answer is we don't know.
Yeah.
And the reason is modelling migration flows is very difficult.
Yeah.
We've had a good crack at it. When New Zealand looks better, economically and than other countries, we do attract more people. but we've had a massive flow of Asian migrants over recent years and decade, and I don't see that changing. People are coming from India, coming from China, Philippines, a lot of other countries, and they're coming here for a better life. So migration flows around the world. You go from a poor country to a slightly wealthier country, and so on and so forth. You're always trying to upgrade. New Zealand's up here. Right, we're up here.
It's important for us to remember that from time to time,
I think so.
We're a highly desirable place to live.
We forget about that. And it's not just migrants, it's tourism as well. Right. Our brand has improved over COVID internationally. People look at the New Zealand experience. Gee, that would have been a good place to have been relative to
my one bedroom flat in London that's about as big as this table.
Well, that's right. Exactly. So I mean, we've imported, I think it's 250,000 migrants in the last year. We lost about 70, and then we lost a few Kiwis. The net migration flow is 130,000. That is a massive number for us.
And what about when it comes to the type of people coming to New Zealand? Do you have any data on, like, obviously we talk about nurses, we talk about teachers, filling the right roles to help New Zealand grow and become more prosperous. Do you have any data on who's coming to New Zealand?
Yeah, we do. A lot of trades. A lot of people coming in and filling those jobs that we couldn't fill a year and a half ago. Most migrants are aged between 20 and 40 or 20 and 30. We're getting quite a young group coming in. They're high participants, right? When you're at that age, you come here, you want a job. So the pressure on wages has actually come off quite a lot. So from employers' perspectives, right?
Because nobody could. You talk to a mortgage broker, a plumber, a lawyer, a builder. It doesn't matter. The theme for the last couple of years has been around trying to attract talent as well, right? So that's really important.
And that has changed a lot.
Because one of the things I've been wondering is volume's great, but we need the right people here as well. But you're saying that the right people are coming? And we're starting to see it in the labour market data. We're hearing it from our clients. They're telling us, we're back open. One client we've got in Queenstown owns 5 pubs, right? He was operating 3.
Just couldn't get the staff.
What's with the other 2? Couldn't get the staff. Had the tourists. Couldn't get the staff. Now he's back to operating all 5.
I think one of the localized problems, especially in Queenstown, though, which I think maybe links into the kind of the property side of the immigration flow and the demand, is they just can't find anywhere to house the staff down there.
Airbnb
it's just absolutely killed it.
It's a real problem. Every time we talk about housing, we focus on demand and we talk about interest rates. It's not where we need to be. We need to be talking about supply. The issue with Queenstown, simply not enough supply. Issue with Auckland, no matter where you look, we've got a chronic shortage of housing in this country, and it's embarrassing. The reason is because we haven't spent money on infrastructure. But we haven't made land available, basically. And we just don't seem to be able to build at scale like you see in places like Australia. When they really want to ramp things up, they do. And they actually had an oversupply of housing over there.
And why, like, is our ability not to build houses a lot to do with just, we're a small island nation in the scale? Or, what is why are we not building enough houses?
That's the best excuse that you often hear. I think it is an excuse. And we don't have the scale, and a lot of it's true. When you look at how we build houses here, it's a group of 3 builders getting together and away they go. You don't have those big sort of organizations that you get in like your Leightons and that in Australia. We need more of that here, larger scale. I was talking to a few builders. I was at a conference about the future of building, and it's all prefab and this sort of stuff. I'm like, why don't you set up a prefab? He said, in order to do that, I'd need to turn over 1,000 houses a year to justify the expense. He said, I'm a big builder in New Zealand and I'm building 300 a year. And I'm big. I'm considered big. I'm like, well, Kangaroa has to be the one that does this.
Yeah.
Right?
Yeah.
And I think they will.
Yeah.
They'll break the ground, but it's just taking too long.
Yeah. We were talking to a developer a couple of weeks ago, and he's doing, I think, 500 houses a year. And he was saying, echoes the same sentiments, but a big thing for him was he's like, we just need to privatize the consent process because there's such a bottleneck at the consents and it has such a flow-on effect for everything else they do. And it was a really interesting discussion actually, because there's positives and negatives, to privatizing stuff or leaving it public. And he was just like, that is a huge bottleneck in our business.
Yeah.
So James, before we continue, I have got a special announcement.
Have you started sticking to your budget?
Absolutely not.
You finally made it as an after-hours DJ.
I wish. Mate, the thing is, we have got a brand new podcast partner, Partners Life.
You mean the award-winning insurance provider with over 300,000 Kiwis insured?
Yep, they're also a New Zealand-operated company, and they are passionate about increasing financial literacy amongst Kiwis.
Sounds like a great match. Where can I learn more about them?
Check out their website in our show notes below.
Really thought DJ Magic Mike was going to be a global sensation for a second. So what do you think is going to happen to rents this year?
Oh, they're going to keep going up. We've already seen rents start to accelerate, unfortunately.
Yeah.
And that just shows us, go back to your economics course, increase in demand from your migrants.
Yeah.
Not enough supply. What does that do to price?
Yeah.
Well, unfortunately, rents are running at over 4%.
Yeah.
Prior to COVID, they were running, I think, a little bit below 3%. So they've definitely ramped higher in response to this migration boom.
Yeah. And when it comes to housing prices, so building consents not looking in great shape at the moment, is that right?
Yeah, so we've gone through a couple of years of correction. The housing market obviously ran ahead of itself. We saw a 45% gain in house prices in 18 months. Show me a few other asset classes that do that. And then we've gone through a bit of a correction, right? I think we dropped about 17%. Things are stabilizing now, and the outlook is of course, prices start to pick up again.
Yeah.
During that, it's hard for builders to get out there, hard for big developers to want to do stuff when prices are falling.
Yeah, they've been beaten up for the last couple of years, right? And there's a lag off the back of it. But then I'm just thinking, if we've got the migration numbers, a lack of houses getting built, lack of supply of rentals, and then you think inflation starts coming down, interest rates start coming down, Kiwi confidence in property comes off the back of it.
Yeah.
Is there potentially quite a bit of risk of property
it's a recipe
prices
for another run?
Yeah, moving too quick?
I think it'll take time, this particular recovery. But you've also got a central bank sitting in the background going, we don't want that to happen. We're going to make sure that we don't get another 45% gain in house prices in 5 minutes. So they've brought in debt to income. It's in the consultation phase. Yeah. It's coming.
Yeah.
And LVR restrictions, that sort of macro prudential policy is there. The guardrails are in place.
Yeah.
Banks aren't going to do that lending again.
Yeah.
What are your thoughts on debt to income ratios?
Oh, I think from the Reserve Bank's point of view, it's another toy, and it's another set of rules that will limit excesses in leverage and in the credit creation. You create money as banks effectively, and they just want to make sure that we're not over leveraging people in high risk sort of investments. Lowering the risk is, I think, the key for the bank.
Yep.
And obviously, the more debt you have to your income, or the higher the loan is in comparison to the value of the property, it's
all risk.
All added risk, isn't it? So they're just trying to keep a lid on that, which means that you won't see as much of a house price spiral, but you won't. The downside has also been limited.
Yeah. And then I guess one of the other things that we often hear about at the moment from our customers and the questions they have is around, we've got a new government. They're saying we've got too much spending. We've got to focus on the debt, cut the spending. Where do you see the New Zealand government debt and spending at the moment? Are we in a good position, a bad position? Could we be in a better position? And what's your sort of forecast, or what are you thinking over the next kind of 2 to 3 years? I think
what the new government's trying to do is admirable, right? I do think we really need to focus on spending, and spending well, rather than throwing money away, which we're seeing.
There's that noise recently about the $500,000 speed bumps in Auckland.
That's just incredible. How do you get to that point?
The economic cost of a speed bump drives me insane. Yeah. But anyway.
Continue.
Yeah.
No, you're right. A lot of that needs to be stamped out. And I'm kind of hoping that we do see a lot of that go, that mismanagement, that poor spending. The thing that I do like reminding people is that we've actually got a very low level of debt.
Yeah.
At the sovereign, the government level,
which is quite interesting, right? Because the narrative that you hear in terms of responsible spending and just look how much debt we've got, so it's an interesting view.
Yeah, well, when we were really banging the table back in 2018, we were saying, now is the time, and that time just got better and better and better as interest rates fell. Now interest rates are high again. It's still a good time, because a lot of things that we want to get done, the longer you postpone it, the worse things get, and the more expensive it is to get things done. We have amongst the highest quality government debt in the world. We're AAA rated under Moody's, AA+, under S&P. That's really high. Like there's only 10 countries in that group. And you're mixing it with, Luxembourg and Singapore and places you can't find on a map.
Nice company.
Very nice company. So we've got a very good starting position that we could expand the government's debt by quite a lot if we wanted to. There is an argument, because we're shaky isles and we might get an earthquake, we might get, we need to have a significant buffer. We've got a massive buffer. We really have.
And for those, I also hear sometimes around the, who's going to be paying off all of this debt, and you're saying we're in a position to take more debt. Yeah. Do we ever pay this government debt off at some point, or how do we, what does that look like as the, if you do think we should take on more debt?
Well, in terms, it's all about percentage of GDP, right? So if you look at some of the multipliers of government investment, like if you did really good quality government investment, let's say we fixed all the railway issues in Auckland right away, well, the multiplier of that is actually quite large in New Zealand's example. So you spend $1 and you're getting like $2.70 worth of output on the back of it. This is treasury numbers, right? That's massive, and it's embarrassing. The reason it's so big is because we've underinvested for decades. But let's say we fixed the railway, the huge impact that would have on Auckland's economy would be great, right? So you would end up with a larger economy relative to your debt. Your debt would always keep increasing under this scenario, but your economy's growing by more, so your tax take, your ability to service that debt and pay it off in the future is greater. And we need that mindset. And we need to say we're not going to try and do all this in one election cycle, 3 years, because it's not going to happen. You need your 20-year, 30-year horizons.
Opposed to chopping and changing when you go from blue to red. And having it funded is the key. Right. We've got one of the strongest balance sheets in the world. We have an amazing ability to issue debt at relatively low rates and for long periods of time. There is an appetite from ACC, other insurers, to buy long-term debt. They need it. They need that rate. So we could easily issue, 30, 50-year bonds. So how do you go about, changing plans every 3 years to having that kind of long-term, potentially independent view of, investing and making sure we're working to a long-term plan?
Communism.
That's very long-term thinking.
Too long.
But you suggesting some sort of like a way to do that would be like some sort of independence on how this money is invested?
Yeah, you're absolutely right. I think that's key. And I think the government's talking about that now.
And when you look at other countries around the world, are there examples of where that's been successful?
Yeah, in Australia. Australia is very good at this. they started their super fund a lot earlier.
Yeah.
They've got, I think, the 4th or 5th largest super fund in the world. Australia's this big, less than 2% of the global economy. One of the largest sovereign wealth funds, massive. We just need to copy what they're doing. It hurts me to say that, but it's true. And you get these infrastructure funds set up, and that they don't get banged around by election cycles.
Yeah, it was really interesting seeing. We were in Adelaide a couple of weeks ago and seeing the debate over there about the politicians putting pressure on the Reserve Bank to cut interest rates now and do it quite quickly. And thank God the Reserve Bank over there said, no thanks, mate, stuff off. Which was really interesting because, they're always meant to be kept separate. So you don't get this changing back and forth of policy and the influence and how they would impact the economy. But really interesting seeing the Australian politicians just directly going at them like, we're coming for you, you need to do this, basically to buy votes.
Exactly. So we sort of figured out in the 80s that wasn't good. Governments just slashing interest rates in the lead up to elections and that sort of stuff. They got to be independent, and they got to be focused on inflation. And they will be fierce in their independence because it's critical, right?
Speaking of coming back to interest rates, been a lot of chat about like soft landings, hard landings. What is, for those who don't know, what is a soft landing?
Soft landing would be, New Zealand's had a bit of a recession. I certainly wouldn't call it a bad one because unemployment's still really low. So what we're going through kind of feels like a soft landing. We are slowing down. The economy's contracting a little bit. We'll hopefully come out the other side with unemployment around 5.5. Not 3.2, but it's certainly not where we're putting lots of money aside for defaults. There's an exponential relationship with the unemployment rate and bank defaults. From 3 to 5, we're okay, we're cool. From 5 to 6, 7, things start picking up. You get up into the 8s and into the double digits, that's when you see the real pickup. So we don't want that. That's a hard landing. When, a soft landing would be getting to 5, 5.5. Hard landing's basically, you come off without a helmet and a mouth guard. That's a hard landing.
And it's around that unemployment rate and then the knock-on effect in the economy, basically.
You're right.
And the so last week there was a little bit of news around potentially, a lot of people think we were at the top with interest rates. I think it was the ANZ chief economist saying that maybe there's 1 or 2 interest hikes to go, and then a little bit of back and forth about whether that is the case or not the case. What are your thoughts? Are we at the top? Do we have a jump or 2 to go?
We think that we're at the top, or that we've seen the peak. But ANZ, you have to listen to what they're saying. They're making some good points. The Reserve Bank is very hawkish. They're very aggressive, and they want to make sure that they've broken that inflation beast, and they don't think they've done that. So, we looked at the inflation report as saying, well, look, the headline rate's gone where it needs to go. The core measures are looking good. The domestic inflation probably a little higher than what we thought it would be, whereas the Reserve Bank's just gone, domestic inflation, that's our problem. So we haven't won the war, basically. So there is a chance that there's another couple of hikes.
And that's that distinction between inflation that we import versus the inflation that we control in New Zealand.
Very interesting, Jarrod. So we're going to do this as a 2-part series. Essentially, Jarrod's told us about all the things that he thinks is happening in the world, happening in New Zealand. We're going to do the next one on what Jarrod thinks he would do. So make sure to follow us for that episode. Jarrod, thank you very much for joining us.
Pleasure, thank you.
And thank you to Partners Life for sponsoring us. Please make sure to review, like, subscribe, and we'll catch you next time.
Cheers.